that money. We do all this work. You're here at conference learning how to earn more money, make more money. And what do? It's really hard to keep that money. So we're going to have some discipline. I want to give you some discipline and some tools that you can use to help keep some of that money, right? You owe it to yourself to keep it. Why don't we keep it? Well, one, we voluntarily give it away, mostly. Okay, some of it is not voluntary. We have to pay bills, pay rent, pay gas. Oh, that gas. Oh my gosh, right? But the government also takes it, and we also make some pretty bad investment decisions from time to time. Okay, so let's talk about our spending. We voluntarily give our money away. Okay, and we're seeing this happen right now, right? So some of the statistics too. I've seen U.S. savings rates plummet from last year. Now, we had a spike in savings during COVID because you couldn't spend your money if you wanted to, right? The government was giving you money and there was nothing to do with it. Okay, and people went out and they saved a lot, but they also spent a lot, once that was over. So we've seen that come down. So we see savings going down. People kind of got accustomed to this lifestyle during the good times. They're not making as much, and they're still spending the same. What does that mean? We're seeing credit card balances go up. Okay, we see auto loans going up. Okay, so this is going to be a path to financial destruction. Now, the number one thing that you can do is at least just be aware of your spending. Before you do anything, before you change your habits, if you change your lifestyle, if you sit down and put pen to paper, if you would just be aware of what you're spending and what you're making, you automatically will start doing things and making different decisions. I promise you. Just being aware, not putting our head in the sand and just looking at it. Even if it's depressing, just to have that knowledge is key to having financial success. Okay, so one of the things that I would recommend for those of you who want to is use this app called Truebill. Anybody have this app on their phone? Anybody download this app on their phone and never use it? Or they linked their accounts, forgot their password, gave up, right? Of course. Little bit of work, guys, little bit of work. This app is amazing. I highly recommend it. You're going to have this dashboard every day. It's going to sync all of your balances. Yes, occasionally if you change a password, you're going to want to update it. All right? But it's going to show you how much do you have in the bank? What's your credit card balances? How much cash? Do you have any investments? And just having those insights into your spending is key. Tracking your net cash position. They'll actually manage subscriptions and reoccurring bills. We use it in my house. Guess what? My wife and I found out we had 2 Spotify subscriptions. I had no idea. We had the family plan under hers. I must have signed up for one years ago and forgot about it, but we were paying for 2 Spotify accounts, one we weren't using, automatically canceling those subscriptions for us, right? You can create budgets for yourself, but just being aware of what's going on is key. And you get to put the notifications on and be aware. You get to know all of this stuff. Like, hey, here's how much money you've earned so far. Here's bills remaining to be paid. Here's your current spend. Here's your income and spending each month. Here's what's left for spending over the next 14 days, $125 a day. It's all right there, right? Just having that knowledge will help you make better financial decisions. It's very easy to do. Automates it, does it for you. Okay, so there's a QR code there. If anybody wants to download the app, of course, you can find Truebill. I like this, most hated by Xfinity, AT&T, Verizon, right? So it's good, okay? Just being aware of what's going on in your household financially is a very critical step that most people don't do, right? And it takes years for them to get back on track. If you just start the knowledge, I promise you, you'll start making better decisions, even over time, just automatically, okay? It's just gonna happen. A lot of people get depressed when they look at how little they have saved, okay? And I could just tell you, after doing this career for 18 years, it doesn't matter how much people have. Whether they had 50,000, 100,000, or $1 million, everybody feels like they are not doing enough. That is just a common feeling that I have noticed on like 99% of people that I have counseled their finances in my career. It's just normal. But if you look at savings statistics in this country, you're not alone, okay? So these are the median savings that people have in their retirement accounts based on age. Okay, so if I put 100 people, 100 being the highest, 1 being the lowest, number 50 in that stack, if they're under 30, only has $8,000 saved for their future. If they're 35 to 44, it's $36,000. Okay, 60, 90. It doesn't really matter where you are. If you're at 0, you're not that far off from at least being in the middle. And if you follow this loan signing system, you build this business, you get even close to the 10K a month club, right? If you're in the 8K a month club, that puts you in the top 25 to 30% of income earners in the country. Okay, the top 25 to 30% of income earners in the country. The opportunity is there for you. Okay, we got to keep some of that money. All right, taxes. Okay, so taxes, listen, take a sip of coffee. Okay, I don't want you falling asleep. Taxes are a pretty boring subject, but it's important. All right, it's important that we at least talk about it a little bit because I get a lot of questions about this from you guys. Okay, and so how can we minimize our taxes? Okay, so we're going to talk about what are the things we could do. Maximizing our tax deductions, understanding tax brackets and how they work, okay, and understanding retirement plans. That's going to be a good help. All right, so what about maximizing tax deductions? So one thing is to get some good tax advice. Okay, one thing is to have a CPA. Now, there is all the information for you that exists on the internet, as you're well aware. You can self-educate yourself about anything, any concept that you want around finance or taxes. It's not for all of us. You can also hire professionals to help give you good tax advice, even if that's for one time, right? So getting that right tax advice, that consult could be really valuable, even if it's just a one-time consultation that you pay for and you do your taxes on TurboTax, okay? Which I think is great, by the way. Understanding corporate structure as you scale. What's the right corporate structure to maximize those deductions, to minimize your payroll taxes? Okay, so once your business scales, this might become important. And then when we look at maximizing deductions, I just want to caution you to beware that it's a write-off mentality. Do we know what the it's a write-off mentality is? You guys all guilty of that?
New lamp?
Yeah, I'm thinking of bringing homeware into the store, so that's a write-off.
That's a write-off?
Yeah.
Do you even know what a write-off is?
Yeah. It's when you buy something for your business and the government pays you back for it.
Oh, and who pays for it?
Nobody. You write it off.
Who writes it off?
I don't know. The write-off people.
Oh, man. Oh, who's been guilty of that one? Yeah. Okay, so that it's a write-off mentality. David, okay. We've all been David a time or two. You know, I'll pick up the tab, it's a write-off, right? So let's just understand what the value of a write-off is. And so that I'm going to take you to our tax code and talk about something called marginal tax brackets, okay? And so if you want to minimize your taxes and understand the value of a write-off, you need to know what your marginal tax bracket is. So this is based on your taxable income, so your adjusted gross income less deductions, and this is going to say how much you're going to get back on that write-off. Okay, so if I take the Smiths, who have a taxable income of $80,000, and they are married, filing jointly, can we find, oh, they're right here in this bracket? Okay, so if the Smiths write off a $1,000 business expense, how much are they going to benefit? How much do they get back? Quick mathematicians in the room, right? If a 12%, $120, okay? So that $1,000 write-off, they got $120. They're still out $880, okay? Businesses have spending problems too, okay? Much rather pay the $120 and put $880 into an investment account than that write-off, potentially. But just know the value of that write-off. Okay, because it's different. If you are Jess here, who's single, right? Maybe not as much deductions. So her $100,000 income actually puts her in this 24% tax bracket. So how much does Jess get back on that very same write-off? $240. So whatever that was, it cost Jess $760. It cost the Smiths $880. And you have to use that as a business owner, entrepreneur, to make those business expense decisions for yourself. Okay? So that's what the write-off is. It's a portion of it you get back from your taxes, and depends on where you are in your business, how valuable those write-offs are. So when you're building your business, okay, those write-offs aren't worth as much. So just beware that it's a write-off mentality and what's actually happening. Okay, we can also use this. One of the number one questions I get from you folks is, which retirement plan should I do? Should I put it into a Roth IRA or a traditional IRA? Should I do Roth 401k or traditional 401k? Okay, so again, we're going to look at our tax bracket and decide which one's better, because the Smiths, we're going to use that same 12% tax rate if they get $48 back on their taxes if they put it in a traditional IRA. If they put it into a Roth, you get no tax deduction. Okay, now the difference is on that Roth, all the growth that they get on this contribution is all tax-free, which could be an enormous value down the road, versus the $400 that they have in their IRA that only really costs them $352. All the growth they get on that, they're going to have to end up paying taxes down the line, right? If we look at Jess, her situation is, well, because she's in a higher tax bracket, she actually gets $96 back. So it's like double the savings if she did a traditional IRA versus the Roth. And if she's looking at her personal financial plan, because she's in a higher tax bracket, she might be thinking, hey, now's the time to get these tax savings when I'm in this higher tax bracket. Okay? So if we look at it, here's a nice slide that just summarizes which one to do. Basically, if you're in a higher tax bracket now, okay, you could go traditional 401k, IRA, SEP IRA, get those contributions that are tax deductible. If you're in a lower tax bracket, certainly meeting that 10 or 12% tax rate, I would suggest we might want to just pay the taxes and have tax-free growth on all that investment savings in a Roth IRA. Does that make sense? All right, you guys got through taxes. Good job. Pat yourself on the back. All right. So, the other reason why we don't keep our money is because we make some bad investment decisions. Okay? We want to make we make bad investment decisions for all kinds of reasons, okay? And we just want to avoid that, because you work really hard to earn the money, and you work really hard to keep the money. And so when you're going to invest that money, okay, you want to be very disciplined in making some good decisions for yourself, because it's going to matter. And you have to kind of decide whether you're trying to get rich quick or build wealth. Okay, there are different types of investments. I personally have decided I'm not going to get rich quick. Personally, I decided a long time ago that I'm going to work hard, I'm going to earn more, I'm going to keep more, I'm going to invest more, I'm going to grow more, and I'll reach financial independence. Okay, a lot of people want to get rich quick, which could lead us to bad investments. We also get sold bad investments, okay? So we are sometimes put our money into things that aren't going to work out well over the long term. One of the things that I noticed in the chat, right, is one of those things about cash value life insurance. Okay, now there's a big sales team out there, okay, going to tell you about the benefits of cash value life insurance, okay? And we hear this stuff called infinite banking a lot, yes? Right? We see these people, right, telling you about infinite banking, all these new influencers coming out, talking about the benefits of it. Stay away, okay? It's not true. These people are either bad at finance or they're bad people, or both. But they're one of the two. Most of them are good people that are just bad at finance. Some of them understand finance, thus they must be bad people, telling people about infinite banking and cash value life insurance. Because compared to nothing, yes, it's better than spending your money. Okay, but I would argue you can build discipline using things like Truebill to understand how much money you're going to keep, and then investing that when I would get to the grow portion to save your money into things that are going to earn a lot more over time. Okay, so when you're looking at these things, just look at the cons, look at what other people say, right? Dave Ramsey has this on his site and helps a lot of people manage their finances. Shows the difference over time of if you did the infinite banking route versus if you put your money in your Roth IRA route, and it's just math. It really is just math. So there's a lot of conflict of interest in all of that, so I just caution you about that, okay? And look, there's a thing that happens in investing, and it actually happens in lots of places, like in our world, psychologically. The phenomenon is called an escalation of commitment phenomenon. Escalation of commitment phenomenon is crazy. It actually happens a lot in cults that are focused on the end of the world. Okay, imagine if you were in a cult. Okay, imagine you joined this cult and you had to abandon your children, you had to disassociate from your parents, you had to give all of your money away, You had to strip yourself of possessions. Maybe you had to offer your spouse, okay? And that's what's happened. Why? Because you're gonna, the alien's gonna come down and rescue you or whatever the heck was. And imagine you did all that. And then you kind of realize, oh my gosh, it's baloney. It's all BS. What have I done? And a lot of people, why do they stay in the cult? Because even if there's a one, fraction of a percent of a chance that it's true, it's so hard to admit that you disassociated from your family, you gave up your children and your spouse and all your money and possessions for nothing, right? So this happens in investing too. And so one of the first things you want to master too is about a sunk cost. Decisions you've made in the past have no bearing on what you do in the future. So a lot of people say, I've already committed, I've already put this money in, I can't have it not work out. It's going to cost me money to get out. It's better you do. It's better you stop doing the thing that's not working, start doing the right thing going forward immediately. And don't do that escalation of commitment because it keeps getting worse, right? It happens in lots of areas in life and it happens in investing too, okay? Whether it's cash value, life insurance, Dogecoin, whatever, okay? So the other thing is we invest in things, speaking of Dogecoin, we invest in things that we think only go up. We invest in things because we think it only goes up. The stock market's a crazy place. Investing's a crazy place. We only like to buy when it's more expensive. Isn't that nuts? We only like to buy this stuff when it's more expensive. And when it's on sale, no one's at the store, right? If I was like, hey, I'll sell you this watch for $500, okay? You're like, no. I come back next week, I'll say, tell you what, the exact same watch that I showed you last week, I'll sell it to you for $1,000. You're like, yes, that's more like it. I like those same exact shares you were offering me last week, but now they're double the price. That's when I want those shares. But that exact same shares, what if they were worth $250? You're like, no. Raise the price to $1,000, then I'll buy your watch, right? That's what's happening in the stock market. It's crazy. Okay, so look, things go up and down. They go down temporarily, they go up permanently. They go down temporarily, they go up permanently. And there's always something to be concerned about. Are you worried about putting your money in the stock market right now? No, good. All right, somebody from last year. All right, of course, we always have this wall of worry though. We're fighting wars, okay? There's recessions, there's inflation, there's new presidents, whoever we're wanting in the seat, right? We have all kinds of things that have gone on looking back over the last 50 years. But somehow it just kept trucking along. If you put $10,000 in the S&P 500 and just walked away, came back 50 years later, it's worth $1.8 million. All this stuff has happened. How many different recessions, wars, oil embargoes, inflation, stagflation, market crashes, 9/11. I mean, the world's always ending if I turn on the news. This is it. This is different this time, but we just keep chugging along. If we have more time, we're going to be fine. And I talked about what you can do in investing over time last year. So those who are with me in Las Vegas, remember I brought out some products for you? Talked about my shoes, talked about my phone, talked about my iPod. You're like, oh, this is great. I could go and invest in things and make money. And then what happened? Market's down. You're like, Dustin, that didn't work out too well, buddy. How am I just going to listen to you, right? Stock market's down since I talked to you last, right? Because I said that had you instead bought these products, instead of buying the iPhone when it came out in 2007, if you use those same dollars to buy the stock of Apple in 2007, it'd have been worth over $40,000 today. That hunk of junk that I have as a relic could have been worth $40,000 in Apple stock. Had I gone back to October 23rd, 2001, and instead of buying the iPod, bought Apple stock, it would have been worth over $160,000 today. What if we bought the companies that sold us the products instead of just the products, or at least buy both? Okay? Now, what happened had you gone back in time and done that? If you went to October 23rd, 2001 and actually bought Apple stock when the iPod came out, 18 months later, it was down 25%. Imagine if you sold and missed out on all that growth because the investment just went down. If you did the same thing with the iPhone in 2007, This is literally to the day, 18 months later, it was down 30%. This is just part of investing, okay? We can't just invest with the notion that things only go up. Imagine if you're like, well, this isn't working, right? I'm going to sell. Oh my gosh, I missed out on tens of thousands of dollars of growth, right, by making that decision. Or versus if you bought more during this time, because it would have been even worth more money than what I'm quoting. You're buying at a lower price, okay? So we have to understand what we're doing in investing. Over time, our odds of making money go up, okay? Over time, over 5-year investment, if I look at the S&P 500, 9 times out of 10, you're making money. 10-year periods of time, it's 10 out of 10. Okay, time is the number one ingredient. If you don't need your money tomorrow, right, I'm going to be a long-term investor. If you do need your money tomorrow, you might not want to invest so aggressively. And I'd also just caution you as well about putting all of your eggs in one basket, okay? So putting it all in one company, putting it all in one investment, it's kind of akin to gambling. Lots of different things can happen. Okay, we're not going to predict when the next iPod, iPhone, or Jordans are going to come out. We should probably have a number of different investments in our portfolio. Okay, it's going to be a little bit better. So that takes us to our next thing, to grow more money.